Is Fidelity FDIC insured? Fidelity Investments is not a bank. It is a brokerage firm. This distinction is crucial when considering insurance. Banks accept deposits. These deposits are insured by the Federal Deposit Insurance Corporation (FDIC). Brokerage firms like Fidelity do not accept deposits in the same way. Instead, they hold customer assets like stocks, bonds, and mutual funds. These assets are not FDIC insured. Instead, they may be covered by the Securities Investor Protection Corporation (SIPC). SIPC insurance protects customers against losses due to the insolvency of the brokerage firm itself. It does not protect against losses in the value of the investments themselves. Think of it this way. SIPC protects you if Fidelity goes bankrupt. It does not protect you if your stocks go down. Cash held in a brokerage account awaiting investment may be covered by SIPC. However, it is not the same as FDIC insurance. One fascinating fact: SIPC does not cover all investment types. Certain investments like futures and options contracts may not be protected. Understanding the difference between FDIC and SIPC protection is vital for any investor. Knowing where your money resides and what protections apply ensures informed financial decisions. Always research the specific protections offered by any financial institution before entrusting them with your funds.